This is OwlUp, where learning happens in minutes, not hours. For a deeper journey, explore all our courses at owlup.co. Now, let's dive in. Welcome back to Chapter 2 of our series, Debt, Friend or Foe? In this episode titled Leverage, the Power Play, we're going to explore the concept of leverage, what it is, how it works, and why it can be a game changer in your financial journey. So, let's dive in. A company with billions in cash still takes on debt. At the same time, a smaller firm with steady profits collapses because its interest bill quietly eats it alive. Same tool, opposite outcomes. In this episode, we'll explore how leverage becomes either a shortcut or a trap. In this episode, we're stepping into the gray zone where more isn't always better and safer isn't always smart. Some of the most disciplined investors deliberately add debt even when they don't need to, while others refuse it and quietly lose ground to bolder competitors. The difference isn't bravery, it's precision. We'll look at why private equity deals in 2022 were comfortable stacking debt at over 6 times EBITDA, and how a rate hike can suddenly turn a solid business model into a fragile one. We'll unpack why a company like Apple might borrow billions while sitting on a mountain of cash, and what its CFO is really optimizing for. Most importantly, you'll learn how to read the early warning lights, coverage ratios, cash buffers, and interest sensitivity before the numbers turn from helpful to hostile. Here's the twist. The numbers that make leverage look attractive are often backward-looking, while the risks are hiding in the future. Deals are modeled on last year's margins, last year's demand, last year's rates, yet the interest meter only runs forward. That's why two firms with similar coverage ratios can face totally different odds. One sells must-have products with pricing power, the other survives on thin, cyclical demand. We'll look at how cash flow durability, contract quality, and refinancing risk quietly decide whether added debt becomes a weapon or a countdown timer. Listen to how the numbers line up in a calm year versus a stormy one, and leverage suddenly looks very different. Start with the basic trade. You're swapping flexibility today for amplified outcomes tomorrow. Cheap, fixed-rate debt effectively locks in your input cost and lets you keep more upside if cash flows grow. But that same fixed obligation becomes heavier if revenue stalls or margins compress, because the liability doesn't adjust when your world does. That's why sophisticated users of leverage obsess over variability, not just size. They map cash flows by bucket. What's nearly guaranteed, subscriptions, long-term contracts, what's seasonal, and what's purely opportunistic. The more of your interest bill you can cover from the almost guaranteed bucket, the more aggressively you can push the rest. Notice how this differs from simply watching a single metric. An interest coverage ratio can look fine right before a contract expires or a key customer leaves. The better question is, how many things have to go wrong before my coverage breaks? Lose 10% of revenue? Refinance 30% of my debt at higher rates? Take a 20% margin hit? Stress testing those combinations reveals whether your capital structure is sturdy or brittle. Maturity dates matter just as much as amounts. A wall of refinancing in 1 year concentrates risk. Staggering maturities over time spreads it. When rates jump, a 1-point move now means hundreds of billions more in global interest expense. Whoever must roll large chunks of debt this year pays the price. Others with long-dated fixed terms effectively bought an umbrella in advance. Then there's liquidity. Not just cash on hand, but true access to funding. Untapped credit lines, covenant headroom, relationships with lenders. These are the shock absorbers. Companies that treat them as lazy assets discover in a downturn that optionality is an income stream in disguise. Your challenge this week: pick one business you know well, your employer, a company you follow, or your own venture, and map 3 things on a single page. 1. How predictable its core cash flows really are. 2. When major obligations come due over the next 5 years. And 3. What specific events would force it to refinance or raise capital under pressure?
Don't estimate ratios. Trace timing and fragility. By the end, you'll see whether additional debt would sharpen its edge or thin the ice under its feet.
Think of two founders standing courtside, both eyeing the same star player. One signs a short, expensive contract, betting this season's performance will justify the cost. The other locks in a longer deal at a fair price, knowing a single injury or slump would make a short-term bet deadly. The math on day one might look similar. What's different is how many bad games each can survive. Real companies face this choice constantly. A fast-growing SaaS firm might add debt to fund sales hires, confident that recurring revenue will cover the bill even if growth cools. A cyclical manufacturer using the same leverage for a new plant is exposed to every downturn and commodity swing. The structure isn't wrong, the fit is. Watch how the best CFOs behave. They align repayments with cash inflows, avoid stacking expiries in a single year, and pre-fund when markets are generous instead of when they're desperate. The worst wait until they need money, then discover cost and control move in opposite directions. Rising rates turn leverage into a moving target. Rules that worked last decade may quietly fail the next. As AI-driven credit models scan patterns humans miss, the real edge shifts from having debt to understanding its behavior under stress. Tokenized assets and DeFi rails may let individuals stack leverage the way hedge funds once did, but that also invites new forms of runs and cascades, more like flash crashes than slow, visible crises regulators are used to managing. In the end, treating leverage as a fixed rule, always use it, or never touch it, is like coding with only if-else and ignoring everything in between. Its real value shows up when you model scenarios, not slogans. How fast cash flows can recover, how quickly terms can change, and how much control you're willing to trade for speed when the next cycle turns. Start with this tiny habit. When you open a new browser tab, add one line to a simple leverage log, where you note a task you're doing and ask, what could do this 10x better than me? And write just one concrete answer, a person, a tool, or a system. Then, once per day when you grab your phone to check social media, instead send a 1-2-sentence message to one person who could be a leverage point for you. For example, can I get 10 minutes of your brain on X this week? Keep it scrappy, imperfect, and fast. Your only job is to keep spotting leverage, not to act on all of it yet. This was OwlUp, your daily step forward. To keep learning with structured courses and more insights, go to owlup.co. Until tomorrow!